So the first thing is, what are the conditions which are to be fulfilled if a person wants to claim an exemption from UAE corporate tax on the transfer of assets or liabilities between qualifying groups? The first condition is that what is being transferred should be assets or liabilities. Now, while in certain countries, even business undertakings are considered as an asset and therefore might be covered under the provision of this article, given that there's a separate article which deals with transfer of business undertakings, it may be possible to infer here that what is contemplated for being transferred or getting the benefit of Article 26 are assets or liabilities. It could be one or more of assets or one or more of liabilities, but what should be transferred should be assets or liabilities. The second condition is, what is the relationship between the transferor and the transferee? Both the transferor and transferee should be a member of a qualifying group. Now, what is a qualifying group? That is something we are going to discuss in the next slide. The third condition is that both the transferor and the transferee should be a taxable person. If they are an exempt person, then these transfer will not be eligible for the benefit given under Article 26. So both of the transferor as well as the transferee have to be taxable person. And the fact lies here that, if there is a transfer between a taxable and an exempt person, or a transfer from an exempt person to a taxable person, while an exempt person will not pay any tax on gains arising from transfer of an asset, the person who is a taxable person may actually claim tax depreciation on such assets and therefore reduce their tax liability. And the last condition is a business transfer covered here? Like I mentioned in point number 1, although in some countries assets are construed to include even business undertakings, but given that there is a separate article dealing with the transfer of business, therefore it may be safe to assume that this particular article relates only to the transfer of assets and liabilities and not business. Of course, with a period of time, if there are any additional clarifications which are given, that is something we are going to cover as they come. Now, basically, in order to be constituted as a qualifying group, there are certain conditions which are prescribed. The first condition is that the resident juridical person or a non-resident having a PE in the UAE are considered as taxable person. So a taxable person will include a resident juridical person, a person who is a resident of UAE, or a non-resident having a PE in the UAE. Now, how will a non-resident have a PE in the UAE? That is covered as a separate part of this particular course. But if there is a non-resident, let's say for example, who has a branch in the UAE, the branch of the non-resident in the UAE will be considered as a taxable person. If the non-resident incorporates another company here where it owns 100%, and the branch transfers certain assets to the company under a reorganization, that will be covered under Article 26. The second condition is that none of the taxable person or none of the people who are transferring the assets or liability or receiving the assets or liability should be an exempt person. Now, there are various category of people who are considered as exempt person. The details have been covered in our course, so therefore you can just refer back to that. The third condition is that none of the persons should be a qualifying free zone person. Now, like I briefly discussed in the preceding slide, the idea behind these two provision is that if one of the transferor or the transferee is an exempt person, then the tax neutrality cannot be achieved. When two people are taxable, they are paying taxes on their income or they are paying taxes on or carrying forward their losses. What happens is one is giving away an exemption in the form of depreciation, the other one is getting depreciation. To maintain this tax neutrality, the net book value of asset in the hands of the transferor is what is considered as the net book value in the hands of the transferee. But if one person is exempt and the other one is taxable, there could be situations where tax arbitrage can be created, and therefore this has been specifically excluded from the purview of being a qualifying person. If a person does not constitute a qualifying group, then the transfers are not exempt. The financial year of both the transferor and the transferee should end on the same date. That's another condition, because the other reason for this is then there will be no mismatches in terms of the depreciation foregone by one and the depreciation available to the other. And the accounting standards followed by both of them should also be the same. Now, the sixth condition is relating to the ownership of the transferor and the transferee. What is that ownership criteria? That we're going to see as a part of our next slide. Now, the ownership criteria for being qualifying as a qualifying group under Article 26 is of two parts. One taxable person has a direct or indirect ownership interest of at least 75% in the other taxable person. Now, if you see the diagram on the left side, Company 1 has 100% ownership in Company 2, right? Since this is more than 75%, therefore Company 1 plus Company 2 would form part of the same qualifying group. Similarly, when we look at this, Company 1 also owns 75% in Company 3. Now, the condition is at least 75%. It is not more than 75%. Therefore, since 75% is owned here, therefore Company 1 and Company 3 also form part of the qualifying group. The assumption is that all Company 1, Company 2, and Company 3 are taxable person. A third person has a direct or indirect ownership interest of at least 75% in each of the taxable person. Now, when you look at it, insofar as Company 2 and Company 3 is concerned, a third person, that is Company 1, has 75% or more stake in both these companies. Now, when this happens, the companies in which there is a common shareholding. So if you see, the point number 1 or A was relating to direct ownership, whereby the owner and the investee were qualifying as qualifying group. In this particular case, what happens is the entities in which there is a ownership stake of at least 75% between themselves, that is Company 2 and Company 3, will also form part of the qualifying group. The difference between A and B is, by virtue of ownership, the investor and the investee were constituting member of the qualifying group. But the point B is, in this case, only the investee entities and not the investor between themselves will form part of the qualifying group.